Hello, today let us look at the accounting cycle, or basically the financial accounting process, where we will be able to understand how transactions are recorded, classified, and then we'll be able to summarize them into the financial statements, okay? And it begins first by identifying the transaction that has happened, and being able to quantify that transaction. That is, be able to see this, the transaction value is of this amount, shilling or dollars, okay? So we have to be able to quantify that transaction and be able to trace this transaction to a source document. A source document, for example, is a receipt, an invoice, a contract agreement, okay? So that is basically a source document. So an accountant needs to see this source document to be able to see the value of let's say, for example, you went and bought cups. You were given a receipt. The receipt indicates the value of those cups that you have bought, okay? And in later, we're going to understand auditors come to investigate, or rather to audit the financial statement. They look at also the source document to see that this check was done, to see that what we have recorded or what a business has recorded can be traced to the source document, okay? Then after doing that, they record that transaction by passing a journal entry, basically by being able to debit a certain account and credit another account. This is because of the double entry accounting system, okay? And this means we are able to identify the two things that are happening when a transaction happens. For example, we went and bought these cups. What happened? We got the cups, that is, we received inventory, so we debit inventory, which is an asset account, and we are going to credit cash because cash has moved from the business to the supplier. So we are showing a decrease in the cash account in the business, okay? So that is, at this point, the accountant basically records that that transaction by passing that journal entry, okay? After that, this is posted in the ledger, and the ledger, basically what it does, it classifies this account. It has there is usually a chart of accounts that summarizes the type of account into either an asset account, a revenue account, an expense account, a liability account, dividends, okay? So you're able to see these are expenses account, and each account, for example, if we had rent expense account, we are able to see these are the debits. These are the debits during the period. These are the credits during the period, and we are able to see the balance at a particular point in time, okay? So the ledger is able to summarize these accounts and be able to classify. So if you have rent expense, we have salary expense, we have utilities expense account, we know these are expenses account. Then we go see an inventory account, a cash account, a prepaid expense account. We have classified them as per chart of accounts. This is our assets account. So the ledger allows for classification and to be able to summarize, and can also show the balance as at a particular point in time of a certain account, okay? Then after that, if you are looking at we want to look at a particular period. Maybe now we are preparing the financial statements as at year end, okay? We pull the trial balance. The trial balance is basically a representation of the balances for each of these accounts, okay? And they should be able to balance in that because of the accounting equation, which states assets are equal to liabilities plus equity of that business. The assets accounts, the value of the balance as at a particular point of the assets, they need to be equal to the liabilities plus equity as at that particular point in time. So it has to balance. Even from the name, the trial balance, it has to balance. If it doesn't balance, it means there is a problem. You have to go investigate where this problem is coming from, okay? And even if the trial balance is balanced, it doesn't mean that your figures are clean. No, there could be an error of omission. If you omit something, if you didn't pass a journal entry, that means there wasn't any debit and credit. So there isn't anything that is bringing about that transaction in the trial balance. So note that even if the trial balance has balance, doesn't mean that there couldn't be no errors. There can be an error, okay? But if it doesn't balance at all, already that indicates there is need for correction. There is need for correction of errors, okay? Once that is done, the next thing is the adjusting entries, the year end or the period end adjusting entries. This is where we look at, because of the accrual accounting, we have, and the matching concept, we have to make sure the expenses are incurred to generate revenue in a certain period. They have also been we are able to report them in the same period, okay? So here you're going to see we need to do adjustment for accruals and for prepayments. So here we're going to see we have prepaid expenses, we have deferred income, we have a deferred income, which is the same as an earned revenue, okay? We have accrued liabilities, okay? So all these things we need to do the adjusting entries. We have also depreciation, we have allowance for bad debt, okay? So these are those period and adjusting entries that we do, okay? Even the closing stock adjustment, which is basically when we are using a perpetual a periodic inventory system. So we have to do adjustment to see the closing stock. So this is where we do all those adjusting entries, okay? Once we have done them and passed the journal entries, then we are able now to get the adjusted trial balance inclusive of all these adjustments that we have made, okay? And once we get to the adjusted trial balance, then we are able to get the financial statements, which are basically, we are able to prepare the financial statement, which are basically the statement of financial position, which shows the assets in the assets of that business as at a particular point, the liabilities and equity of that business as at a particular point in time, okay? Then we have the statement of profit or loss, which shows the revenue that business has earned during a certain period. We less the expenses they have also incurred during that period in generating the revenue. Then we are able to see if that business made profit or loss, okay? Then we have the statement of changes in equity, which basically it looks at the equity structure, and the statement basically is able to show the movement of equity, the retained earnings, the dividends, the profit during the year, so that we can see the retained earnings as at year end, okay? Has there been any shares that have been issued? What is the premium, okay? So all these things are shown by the statement of changes in equity. Anything to do with equity comes to this statement. Then we have the statement of cash flows, which basically shows how cash has been generated and where cash has been generated and used in which activities. Is it the operating activities? We are able to show all of them actually, operating, financing, and investing. But a user who is using this statement is able to say, is the business using more cash or generating cash from operating or financing or investing, okay? So that is basically what the statement of cash flows does. Once we prepare the statement, remember, for some of the companies, depending on the jurisdiction and also what they are doing, they need to be audited. They need to be audited by law, as per the rules of the law, okay? So here is where the auditor comes, look at the statement. They now even, are given actually the trial balance. They can do they do test work that includes checking even the source document of this transaction, and then they give an opinion on those statements if they are fairly if this statement show a fair and true representation of what is there, okay? Then we have the closing entries that the business does. This is basically closing the revenue account and the expenses account during that period. And also they make the transfer to the retained earnings, so that at the beginning of the next period, we have the correct balances, so that when we come to prepare the accounts again at the next period end, we have the correct opening balances. Okay.